but going forward, you need to know what you're getting yourself into before you get into it. Naked calls. Naked calls are bearish or market neutral. What you want to do as a naked call seller is to gain the premium from the buyer, and you want this stock to really kind of flatline or even kind of just sell off a little bit. So if you see a topping pattern with say the PET D gives a reversal in a particular stock, that would be time to put on a naked call spread. Keep in mind, with the naked call spread, you will receive the premium, but you also have unlimited risk to the upside, in theory. Now, as a person that trades on a daily basis, I'm constantly watching these, so the likelihood of this going to infinity on me is pretty low. And I always know my exit strategy before getting into any trade. So naked callers, like I said, is interested in the same thing as a covered call seller, and that's the income. We're all looking for the income with these, and we're looking to take a little bit more risk. Although without the stock to complement the short call, there is nothing to limit the position's risk if the stock goes up. If assigned, this naked call seller has to buy the shares in the open market to meet the delivery. What does that mean? Well, as a naked call seller, I'm selling the call and I'm collecting the premium, but that gives the buyer of that the right but not the obligation to buy the underlying at any given point. So if this market really rallies up and goes well above my strike price, I'm likely to get assigned, which means the buyer of the option, the person that bought the option from me, is going to say, I want you to sell me that underlying at our strike price. Well, as a naked call seller, the naked in that means that I don't already own this stock or this underlying, and I have to make delivery. In order to make delivery, I have to go into the open market, buy that, and then deliver it to that person at the lower price or at the strike price. So naked call, like I said, is bearish to market neutral. The naked call essentials to success is picking the right strike. What strike is it? And we'll go into this in more detail, like I said, in the online webinars and the online classes. But picking the right strike is usually going to be about a standard deviation away from where the market is trading. That's where I like to get into it, and that's what we'll be mostly talking about. But you also don't want to pick a stock that's so far out of the money that your cost of selling that stock or your brokerage fees are going to eat all of your profit out. And you also don't want to pick something that's so close to where the market is trading that you do gain a lot of income from it, but you're increasing your risk of that strategy not working out correctly. Picking the right duration. Going further out in time, you're going to gain a lot more premium, but you're also not going to see the decay in that premium come as quickly as if you're picking shorter durations. And picking the right duration doesn't even mean necessarily the right option month, whether it's June or July or a weekly. It's picking the right direction within that option. If you sold this call the day the option kind of opened, then you're not going to really see a lot of the theta decay or the time decay in that option happen until about 30 days out. So, and we will talk about exactly when to implement those and when the right duration within each given month is. And picking the right environment. Selling a naked call in an environment where there's very low volatility is not necessarily the right time to do it unless there is a lot of theta decay coming in. That's a nice time to do it is kind of divide your theta by your vega and come up with a percentage there, and there are particular rules involved in that as well. But picking the right environment. You don't want to pick an environment where there's really low volatility going into a earnings play, and you're going to see volatility spike after you've sold it. So picking the right time, the right environment is going to be essential to success as well. And picking the right underlying, like I said before, picking the right underlying, picking something with a lot of volume, a lot of open interest, and knowing your exit strategy before entering the trade. Everybody, you need to know where you are going to cut your losses. You need to know when you're going to cover your winners. You know, a lot of the people that don't like selling options talk about there's unlimited risk, and you have to hold this option until it's worthless to get your full amount of money or your full premium. Well, that's true, but the fact of the matter is the longer you hold it, the more risk you're incurring. So I will go over several rules as well when we start drilling down on these later on in later tutorials as to the specific days and how much you've gained. So, you know, if you're at 3 or 4 days and you've already gotten 50% of your max profit, I would be one to cover that trade and allocate my money elsewhere, because having another 30 days just to get 50% more of my premium that I laid out or that I received isn't worth the risk to me. I like to take my profits quickly if I have the opportunity, and know when to fold them, know when to hold them, and that's when I would be folding them.